Trading in a dove market. A dove market is named after the dove approach in monetary policy, where central banks favor low interest rates and gradual economic interventions rather than aggressive inflation control. The opposite is a hawk market, where interest rates rise quickly to curb inflation. Dove markets typically indicate a nurturing economic environment where borrowing is cheap and consumer spending is encouraged. Traders should recognize that while growth might be slower than in bullish hawk markets, risk-adjusted opportunities are abundant. A dove market is marked by several distinguishable characteristics: low or declining interest rates. Central banks reduce rates to encourage borrowing and spending. This can increase liquidity in the market, which traders can exploit. High market liquidity. Increased liquidity often leads to a rise in asset prices, particularly in equities and real estate, presenting profit opportunities. Moderate inflation expectations. Dovish policies aim to stimulate growth without immediately triggering high inflation, creating a stable environment for investment. Risk on sentiment. Investors are often more willing to take on risk, favoring stocks, commodities, and emerging market assets. Several key economic indicators signal a dove market. Central banks' decisions on interest rates, inflation trends, and unemployment rates are prime indicators. For example, when the Federal Reserve maintains a historically low interest rate, it reflects a dovish stance. Inflation rates that remain below the target range, combined with steady GDP growth, further confirm the market's dovish behavior. Understanding these indicators allows traders to anticipate market trends and adjust strategies accordingly. Dove markets often feature predictable, steady movements rather than sharp swings. Liquidity is generally abundant, volatility is lower, and stock prices tend to respond gradually to news. Traders can identify these traits to adapt their risk tolerance and optimize entry and exit points. The primary difference between dove and hawk markets lies in central bank policy and investor sentiment. Dove markets encourage investment and consumption with low borrowing costs, while hawk markets restrict liquidity to fight inflation. Traders in a hawk market must anticipate rapid interest rate hikes that could destabilize equities, whereas in a dove market, the focus is on slow and steady growth. Recognizing these dynamics helps traders align their strategies with prevailing economic policies. Certain sectors thrive in dove markets. For instance, technology and consumer discretionary stocks often outperform because low borrowing costs facilitate expansion and consumer spending. Conversely, sectors like utilities and consumer staples may offer stability but limited growth opportunities. Traders should evaluate sector performance carefully, balancing growth potential with risk exposure. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 25% off your next purchase. Investor psychology plays a significant role in dove markets. When rates are low and economic growth is stable, investors tend to favor equities over bonds, resulting in moderate optimism. Traders should monitor sentiment indicators such as the volatility index or VIX and market breadth to gauge confidence levels. Understanding how sentiment drives buying and selling behavior allows traders to anticipate corrections and capitalize on subtle trends. Adapting trading strategies to a dove market requires careful planning. The low volatility environment favors certain approaches over others. Traders can focus on long-term investment, swing trading, and risk-managed positions to maximize profitability. In a dove market, buy and hold strategies often excel. Investors targeting dividend-paying stocks or strong fundamentals benefit from compounding returns. For example, purchasing shares of a high-quality technology company during a period of low rates allows traders to ride steady growth while collecting dividends, minimizing stress during minor market fluctuations. Swing trading is ideal for exploiting small, predictable price movements in dove markets. Traders can identify short-term upswings or pullbacks within an overall steady trend. For instance, if a consumer discretionary stock consistently moves between $50 and $55, a trader could buy near $50 and sell near $55, repeating the pattern while maintaining disciplined stop-loss strategies. Options and other derivatives can serve as effective hedging tools in a dove market, particularly for traders looking to manage risk while maintaining upside potential. Call options can amplify gains on growth stocks, while put options can protect against unexpected market reversals. Traders who employ risk-adjusted strategies using derivatives can benefit from market volatility while minimizing exposure to negative shocks. Even in calmer markets, risk management is critical. Position sizing, stop-loss orders, and portfolio diversification ensure traders avoid overexposure. For example, allocating only 5 to 10% of a portfolio to a single swing trade reduces the impact of unexpected market events, even when volatility is low. Hedging strategies, such as options or inverse ETFs, can further protect against sudden reversals. Technical analysis is particularly useful in dove markets where trends are subtle. Traders can rely on indicators that highlight minor shifts in momentum and price direction. Moving averages smooth out short-term price fluctuations, revealing underlying trends. In dove markets, using a 50-day or 200-day moving average can help identify support and resistance levels. Trend lines allow traders to visually confirm market direction and potential breakout points, facilitating better entry and exit timing. The relative strength index and moving average convergence divergence are excellent for spotting overbought or oversold conditions. In low volatility environments, these indicators help traders detect early signs of trend reversals before major price movements occur. For instance, an relative strength index below the 30th of May indicate a temporary dip in a steady uptrend, presenting a buying opportunity. While technical analysis captures price behavior, fundamental analysis provides context. Evaluating company health, earnings reports, and macroeconomic indicators allows traders to make informed decisions aligned with dove market conditions. Quarterly earnings reports reveal profitability, growth prospects, and management guidance. In a dove market, companies often benefit from lower financing costs, so tracking revenue growth, profit margins, and cash flow trends can identify stocks likely to appreciate steadily. Monitoring central bank announcements and macroeconomic news is crucial. For example, if the Federal Reserve signals continued dovish policies, certain sectors may benefit disproportionately. Traders who integrate this information into their strategy can align trades with policy-driven opportunities, enhancing their profit potential. Consider a tech stock trading around $100 with moderate volatility in a dove market. A trader might buy at $100, hold for 3 months as the stock gradually rises to $115, and capture the gains without aggressive risk exposure. Similarly, a dividend-focused consumer staple stock may yield consistent income while appreciating slowly. These examples highlight how patience and strategy in a dove market can lead to steady profits. Conclusion: trading in a dove market requires patience, strategy, and an understanding of economic conditions. By focusing on long-term investments, swing trading, and disciplined risk management, traders can exploit the unique opportunities that low-interest, steady growth environments provide. Integrating technical and fundamental analysis ensures informed decision-making, while monitoring sentiment and macro news helps anticipate trends. Dove markets may seem slow, but they reward those who trade strategically with consistent, sustainable profits. Thank you for watching.